You think you're trading the market, but the truth is the market has already traded you before you even click the button. By the time you see the breakout, it's not the beginning, it's the aftermath. By the time your indicator confirms the move, the real players are already taking profits. And while you're chasing what looks obvious, smart money is quietly stepping in the opposite direction. Smart money moves first, retail sees it last, because the market is not built for equal participation. It is built for participation based on access, timing, and intent. When most traders open a chart, they believe they are looking at a live battlefield where every move is happening in real time. In reality, much of what they are reacting to has already been planned, positioned, and partially executed by larger players long before the move becomes visible to the public eye. The concept of smart money refers to institutional participants such as banks, hedge funds, and large liquidity providers who have the capital and infrastructure to accumulate or distribute positions without immediately revealing their intent. Unlike retail traders, they cannot simply enter or exit the market in one moment. If they did, their own orders would move price against them. So instead, they operate in phases, slowly building positions while the market still appears normal, balanced, or even slightly misleading. This early positioning is the critical advantage that defines the entire structure of market movement. When smart money wants to buy, they do not wait for obvious bullish confirmation. In fact, obvious confirmation is often the worst time for them to buy, because that is when retail traders flood in, pushing price higher and making entries more expensive. Instead, institutions accumulate during periods of uncertainty, consolidation, or even mild bearish sentiment. At that stage, retail traders are either fearful or disinterested. Price may look stagnant, confusing, or directionless, but underneath that surface, large orders are being absorbed quietly. This is why the move that eventually appears as a breakout or trend often feels sudden to retail traders, even though it has been in preparation for a long time. By the time retail participants finally see the move, what they are actually witnessing is not the beginning of a trend, but the result of accumulation or distribution that has already taken place. This delay in perception is not accidental, it is structural. Retail traders rely heavily on confirmation tools like indicators, patterns, and breakouts above resistance or below support. These tools are inherently lagging because they are based on price history. Smart money, on the other hand, is not reacting to history, they are actively shaping it. They are concerned with liquidity, not confirmation. Liquidity exists where traders place their stop losses and pending orders, which is often above highs or below lows. This is why price frequently moves into those areas before reversing or accelerating. It is not random, it is where the orders are. The psychological layer is equally important. Retail traders are trained to wait for safety. They want confirmation that reduces uncertainty before entering a trade. Smart money exploits this behavior. When price begins to move slightly in one direction, it creates emotional pressure. Traders who miss the initial move feel the fear of missing out, while those already in a position tighten their stops. This combination of FOMO and fear creates liquidity. Smart money uses this liquidity to complete their positions or exit them. That is why the market often moves in a way that feels like it is one step ahead of everyone else's expectations. Understanding that smart money moves first changes how you interpret every chart. Instead of asking where the market is going next, the more important question becomes why price moved the way it already did. Every move has a footprint of participation. If price moved sharply without obvious reason, it likely means positioning was already complete. If price moves slowly and then suddenly accelerates, it suggests a transition from accumulation to distribution or vice versa. The visible move is just the final expression of invisible activity that has already occurred. In essence, smart money's advantage is time. They operate in the space between perception and reality. Retail traders see the reaction, while institutions create the cause. Once you understand this separation, you stop chasing moves and start reading context. You begin to realize that the market is not rewarding those who act first on what they see, but those who understand what must have happened before anything became visible at all. The market is designed to trap the majority because liquidity is not created by certainty, it is created by emotion. And the easiest way to generate emotion at scale is to mislead the crowd just enough to make them act at the worst possible time. Most traders assume traps are accidental, like sudden reversals or fake breakouts that simply didn't work out. But in reality, the structure of price movement often reflects a deeper mechanism where the market moves in a way that maximizes participation right before reversing. This is not a conspiracy in a simplistic sense, but a consequence of how large orders must be executed in an environment where every trade requires a counterparty. Large participants, often referred to as smart money, cannot enter or exit positions without liquidity. Liquidity in markets is created when retail traders place stop losses, enter breakout trades, or react emotionally to fast moves. Without this participation, institutions would struggle to fill their orders at efficient prices. So the market naturally evolves into a system where price is often pushed toward areas where liquidity is most concentrated. Those areas are typically obvious levels such as recent highs, recent lows, support zones, resistance zones, and psychological round numbers. These are the places where traders collectively act in predictable ways, and therefore they become targets, not because they are technically significant in a pure analytical sense, but because they are behaviorally significant. The trap begins forming long before it becomes visible. Price may consolidate near a resistance level, creating the illusion that a breakout is imminent. Retail traders interpret this as accumulation of buying pressure and begin preparing for long entries above the level. Stop losses for short positions also start clustering just above the same area. This creates a pocket of liquidity that the market can easily access. When price finally pushes upward, it often looks like the breakout has begun. Traders who feared missing the move rush in, adding even more liquidity. At this moment, the market has achieved what it needed, maximum participation. Then the reversal occurs. Suddenly, price collapses back into the range, and what looked like strength becomes a failed breakout. From a retail perspective, it feels like manipulation or randomness, but from a structural perspective, it is simply the market fulfilling its purpose of delivering liquidity to larger players. The move above resistance was not the start of a trend, it was the delivery mechanism for orders waiting to be filled. Once liquidity is consumed, there is no longer a reason for price to stay elevated, so it returns to equilibrium or moves in the opposite direction. This pattern repeats across all time frames. At support levels, traders expect bounces, so they place buy orders and stops just below the obvious lows. Price often dips below support briefly, triggering stops and creating panic selling. That panic becomes the fuel for the next upward move. Again, the majority sees a fake breakdown, but what actually occurred was a liquidity sweep. The market moved lower not to signal weakness, but to collect the necessary orders to support a move upward. What makes this system so effective is the psychological predictability of the crowd. Most traders are taught to think in terms of confirmation. They wait for price to prove itself before acting. This creates synchronized behavior across thousands of participants. When many people act the same way at the same levels, they unintentionally create predictable liquidity zones. The market does not need to guess where traders will act, it already knows, because human behavior repeats itself in structured environments. This is why the market often feels like it is hunting stops. It is not targeting individuals, it is interacting with clusters of decisions that happen to be placed in similar locations. The trap is not personal, it is statistical. The more obvious a level becomes, the more likely it is to attract attention and the more likely it is to be used as a liquidity source. Understanding that the market is designed to trap the majority changes how you interpret price behavior. Instead of assuming that breakouts are meant to continue or that support and resistance will hold, you begin to ask a different question. Where is the liquidity located? And how can price reach it efficiently? Once you shift from predicting direction to identifying liquidity zones, you start to see that many failures in the market are actually the intended outcome of its structure. In the end, the market is not trying to deceive in a conscious sense, but it is built in such a way that the majority's behavior becomes the mechanism through which larger participants operate. The trap is not an anomaly, it is the natural result of a system where visibility, emotion, and liquidity are permanently intertwined. Breakouts and obvious setups often become liquidity traps because what looks clear to the majority is exactly what makes it valuable to the market's larger participants. In trading, clarity is rarely a signal of safety. More often, clarity is a signal that positioning is crowded, predictable, and therefore vulnerable to exploitation. When a breakout level becomes obvious on a chart, it does not just represent a technical boundary, it represents a collective decision point where thousands of traders are likely to act in the same direction at the same time. That synchronization is precisely what creates liquidity, and liquidity is what the market actually needs to function. To understand this, you have to separate the idea of a breakout from the idea of intention. Retail traders see a breakout as confirmation that momentum is shifting in a new direction. They are taught that when price crosses resistance, it signals strength, and when it crosses support, it signals weakness. But this interpretation ignores the underlying mechanics of how large orders are executed. Institutions cannot simply buy or sell massive positions without causing slippage. They require opposing orders to fill their trades efficiently. Those opposing orders are almost always found at predictable technical levels where retail traders are conditioned to act. So when price approaches a widely watched resistance level, something important begins to form beneath the surface. Traders who are short place their stop losses just above the resistance. Traders who are waiting for confirmation place buy-stop orders above the same level. This creates a concentrated zone of liquidity sitting just beyond the visible boundary. From a structural perspective, that zone becomes extremely attractive because it contains both forced buying and forced covering. It is not resistance that matters, it is the pool of orders resting above it. As price approaches this level, it often behaves in a way that reinforces retail conviction. It may slow down, consolidate, or repeatedly test the boundary. This builds confidence that a breakout is imminent. The longer the consolidation, the stronger the belief becomes that once price finally breaks through, it will continue in that direction. This psychological buildup is crucial because it increases the number of participants ready to act at the exact moment of breakout. The market is not just approaching a level, it is accumulating emotional participation. When the breakout finally happens, it appears decisive. Price moves quickly through resistance, triggering stop losses and activating breakout entries. At this moment, retail traders feel validated. Everything they were waiting for is happening in real time. But what they are actually witnessing is not the beginning of a trend, but the execution phase of a liquidity event. The breakout is the mechanism that delivers orders to larger participants who need to exit positions or establish opposing ones. Once enough liquidity has been consumed above the level, the market no longer has incentive to sustain the move. The imbalance that drove the breakout is gone. What follows is often a sharp reversal back into the previous range or an acceleration in the opposite direction. From the outside, this feels like a fake breakout. But internally, it is simply the completion of a process. The market did not fail, it finished what it needed to do. This is why obvious setups are so dangerous. The more visible and agreed upon a setup becomes, the more participants align their behavior around it. That alignment reduces uncertainty but increases vulnerability. The market does not reward consensus, it exploits it. If everyone sees the same breakout, then everyone is effectively standing on the same side of the trade. For larger players, that is not a threat, it is an opportunity. The key misunderstanding comes from assuming that technical patterns are predictive by nature. In reality, patterns are descriptive of past behavior, not guarantees of future direction. A breakout is not inherently bullish or bearish, it is a point where liquidity is accessed. The direction that follows depends on who needed liquidity and why price was driven there in the first place. Once you recognize breakouts as liquidity events rather than directional signals, your entire interpretation of the market shifts. You begin to see that the most obvious setups are often the least reliable, not because they are technically incorrect, but because they are structurally crowded. The market does not move against breakouts because they are wrong, it moves against them because their obviousness makes them useful. In this sense, breakouts are not opportunities by default. They are invitations to examine who is positioned on the wrong side of the move. And more often than not, the answer is the same. When something looks too clear, too clean, and too universally accepted, it is already part of a larger process designed to turn that clarity into liquidity. Institutions don't chase price because chasing price is a retail behavior driven by urgency, emotion, and lack of scale. Large players operate under completely different constraints. When you manage billions in capital, every entry and exit has to be deliberate, fragmented, and strategically absorbed into the market without causing disruptive movement against your own position. If institutions were to chase price the way retail traders do, reacting to momentum after it is already obvious, they would constantly suffer from poor fills, slippage, and inefficient execution. So instead of chasing price, they design conditions where price comes to them. This is one of the most misunderstood aspects of market structure. Retail traders often believe that price movement is the result of demand and supply reacting in real time, as if buyers and sellers are simply competing in an open arena where whoever acts fastest wins. But in reality, large participants cannot afford to act impulsively. They require planning, patience, and above all, liquidity. Liquidity is the ability to enter or exit positions without significantly affecting price. Without liquidity, even the most accurate market view becomes unprofitable in practice. So institutions approach the market not as something to chase, but as something to engineer. They understand that price is not just a reflection of value, but also a mechanism for creating opportunity. If liquidity is not present at current levels, it must be created. And one of the most effective ways to create liquidity is through price movement itself. By pushing price into areas where retail traders are likely to react, such as highs, lows, support, resistance, and breakout zones, they generate the very conditions needed to fill large orders efficiently. This is why price often behaves in a way that feels intentional rather than random. It moves into areas where stops are clustered, where breakout traders are waiting, and where emotional decisions are most likely to be triggered. Institutions do not need to guess where these areas are. They are predictable because they are based on human behavior. Traders are taught the same concepts, use similar tools, and react in similar ways. As a result, Liquidity is not evenly distributed across the chart. It is concentrated in specific zones that can be anticipated. Instead of chasing price upward in a strong rally, institutions often wait for that rally to exhaust itself. They know that momentum attracts participation. As price rises, retail traders become increasingly confident, entering long positions and tightening stops below recent pullbacks. This creates a fragile structure beneath price, one that is rich in liquidity. When momentum eventually slows, institutions can step in to either absorb remaining buy orders or initiate short positions into the weakness, using the trapped long positions as fuel for movement in the opposite direction. Similarly, in a declining market, they do not chase price lower in panic. They wait for fear to peak. As price falls, retail traders begin to exit long positions or open new short positions. Stops accumulate above minor retracements. Institutions then use these conditions to accumulate long positions at favorable prices, often by briefly pushing price even lower to trigger stops and maximize available liquidity. The goal is not to follow the move, but to use the move as a tool. What looks like chasing from a retail perspective is actually controlled participation from a structural perspective. The market is not a place where the fastest reaction wins. It is a place where the most patient positioning dominates. Institutions operate with time as their advantage. They do not need to be right immediately. They need to be right eventually and with enough size to matter. This approach also explains why trends often develop in staged phases rather than smooth, continuous movement. Each phase of a trend represents a different stage of institutional participation, accumulation, manipulation, expansion, and distribution. Price is guided through these phases not because institutions are reacting to it, but because they are actively shaping conditions to optimize execution. Once you understand that institutions don't chase price, you begin to see that most impulsive moves in the market are not signs of urgency from large players, but carefully managed transitions between liquidity zones. What appears chaotic is often structured, what looks reactive is often pre-planned, and what feels like momentum is often the result of positioning that was prepared long before the move became visible. In essence, institutions don't follow the market, they structure their participation so that the market follows their needs. Price is not something they chase. It is something they wait to exploit when it inevitably moves into the zones where liquidity is abundant and participation is predictable. Your edge is not indicators, it's understanding who gets trapped, because indicators only show you what has already happened, while trapped participants show you what is about to be resolved. Most traders spend years searching for the perfect indicator combination, believing that success lies in finding a formula that can predict future price movements with higher accuracy. They stack moving averages, oscillators, volume tools, and complex systems, hoping that clarity will emerge from complexity. But the deeper they go into indicators, the further they drift from the actual driver of price movement, which is human behavior expressed through positioning and emotion. The market does not move because a line crosses another line on a chart. It moves because positions are opened, closed, and forced to adjust. Every candle represents decisions made by traders who are either comfortable, uncertain, confident, or trapped. When traders are trapped, they are holding positions that are losing value and forcing them into emotional and mechanical responses, closing at a loss, adding to positions in hope of recovery, or getting stopped out entirely. These forced actions are what create real momentum in the market, not the signals generated by indicators. Understanding who is trapped means understanding where pain exists in the market. Pain is created when traders are on the wrong side of a move and have no easy exit. For example, if many traders buy after a breakout above resistance and the market quickly reverses back below that level, those traders are now trapped in losing positions. Their stops are hit, or they are forced to exit manually, creating additional selling pressure. That selling pressure is not random, it is fuel. It accelerates the move in the opposite direction. This is why price often moves fastest when it reverses from obvious levels. It is not because the level itself has magical significance, but because that level attracted a cluster of similar decisions. Indicators rarely show this. A moving average will not tell you that thousands of traders are trapped long above a failed breakout. An RSI will not show you that short positions are being squeezed as price spikes upward into a liquidity zone. Indicators are blind to positioning, they only reflect price history. The real edge comes from shifting focus away from prediction and toward participation. Instead of asking where will price go next based on this indicator, the more powerful question is who is currently wrong and what will force them to act. Because markets are not driven by those who are right, they are driven by those who are forced to exit being wrong. When enough traders are trapped on one side, the market gains fuel to move in the opposite direction until that imbalance is resolved. This is why trading often feels counterintuitive. The best opportunities usually appear when everything looks clear but is actually fragile. A strong breakout looks like strength, but if it has attracted too many late buyers, it becomes vulnerable. A sharp drop looks like weakness, but if it has forced enough sellers out, it becomes a setup for reversal. The surface story is always less important than the underlying positioning. Once you understand this, indicators start to lose their authority. They are not useless, but they are secondary. They can help you frame context, but they cannot tell you where pain exists. And without knowing where pain exists, you are essentially trading without understanding where forced behavior will emerge. The market's most powerful moves come from forced behavior, not voluntary participation. The traders who develop an edge are not the ones who predict best, but the ones who interpret imbalance best. They learn to see where traders are likely trapped, above false breakouts, below failed breakdowns, inside tight ranges that suddenly expand. They stop thinking in terms of signals and start thinking in terms of consequences. If price goes here, who loses? If price goes there, who is forced out? This shift changes everything. It turns trading from a game of technical prediction into a study of psychological pressure. Instead of trying to outsmart the chart, you start reading the crowd behind the chart. And once you can identify where the majority is positioned incorrectly, you are no longer relying on indicators for direction. You are aligning yourself with the resolution of imbalance. That is your real edge, not the tool you use to analyze price, but your ability to understand who is trapped, who is uncomfortable, and who will be forced to act next.